You know that Warren Buffett quote, the one about needing your money to work for you while you sleep?
Oh, yeah.
It really nails the core idea we're diving into today, wealth creation.
Absolutely. And putting it simply, wealth creation is about strategically investing your savings,
Mhm.
in the right places to grow that wealth and generate a second income stream, exactly what Buffett was talking about.
Right. And this deep dive, The Learner, is specifically for you. We know you're keen to understand wealth creation without feeling lost in all the complicated terms.
Yeah.
We've looked at a wide range of information for you. Stuff on the fundamentals of wealth creation, building an investment portfolio,
Right.
exploring cryptocurrency, different kinds of investments like mutual funds, stocks, and even, some important warnings about potential stock market scams.
Our goal here is really to pull out the most valuable insights from all of this.
Mm-hmm.
We want to give you a clear understanding of what wealth creation truly means for you, why it's so vital, and some practical approaches you can consider, all in a way that's hopefully easy to follow and keeps you engaged.
Okay, let's unpack this then. When we talk about wealth, what exactly are we talking about?
Well, the dictionary definition is pretty straightforward. Abundance.
Okay.
So when we apply that to finance, it means having an abundance of financial resources.
Yeah.
But what's really interesting is how personal and, well, relative wealth can be.
Ah, right. Like those examples, wasn't it? An apple orchard up in Shimla versus, say, a swanky apartment in South Delhi.
Exactly. Both could represent wealth. It just depends on your perspective, your goals. And that really highlights it. Wealth isn't just about reaching some, magic number. It's about having enough resources to achieve your individual aspirations and financial dreams.
Right.
So whether it's owning that orchard or that apartment, if you don't have the financial means right now, wealth creation is about building that base to get closer to those personal goals. And it's important to remember, it's not just about earning a bigger paycheck. It's about actively investing your savings so they have the potential to grow over time.
So we have a general idea of what wealth is, but why is actively creating it so crucial beyond just, having nice things?
Well, that Buffett quote we started with really gets to the heart of it. The primary aim of wealth creation is to reach a point where your money is working for you, generating what's called passive income. This is really the key to gaining financial freedom and not having to constantly trade your time directly for money.
That makes perfect sense. Yeah, it's about building a safety net and having more choices for the future. The idea of breaking down objectives by different time frames was also really insightful.
Yes, categorizing your goals into short term, like under 3 years, medium term, maybe 3 to 5 years, and long term, many years or decades. That really helps clarify the different roles wealth creation plays in our lives.
Right.
Short term might be that vacation you're planning or, I don't know, a new phone. Medium term could be saving for a car or maybe a down payment on a house. And long term is those big life goals like a comfortable retirement.
And understanding these different timelines really guides the strategies we should be using, right? You wouldn't approach saving for a quick trip the same way you'd plan for retirement way down the line.
Precisely. Think of investments like tools in a toolbox. Each one is designed for a specific job. For short-term goals, the priority. It's got to be keeping your initial investments safe.
Okay.
So lower risk options like liquid funds, think of them as easily accessible savings accounts with maybe slightly better returns and fixed deposits. They're generally more suitable because you need that money readily available and, protected from big market swings.
But when we're looking at those longer term goals like that dream home or retirement, the focus shifts more towards growth. Yeah.
Exactly. That's where you might need to consider investments with the potential for higher returns, even if they come with more ups and downs along the way.
Right. More volatility.
Exactly. An example used to illustrate this is really powerful. They looked at saving a significant sum, say, 4 crore rupees over 20 years.
Okay.
If you only use a fixed deposit at, let's say, a 6% annual interest rate, you'd have to save a hefty amount, like 86,150 rupees every single month.
Wow, that's a lot.
It is. Now, compare that to investing in equity-oriented options like FlexCow funds. These are mutual funds that can invest across different sizes of companies, which, historically, might deliver around 12% annual return.
Okay.
In that case, the required monthly investment drops to a much more manageable 40,035 rupees.
Huge difference.
Huge. So using the wrong tool, like a low-growth FD for a long-term objective, demands significantly more of your current income. It might even make the goal seem impossible.
Okay, so picking the right kind of investment based on our goals is fundamental. Now, let's talk about putting these different investments together, building a strong investment portfolio.
Right. This is where the idea of a portfolio comes in. Think of it as a collection of different types of assets, a way to spread your investments so you're not putting all your eggs in one basket, so to speak.
Diversification.
Exactly, diversification. And just like with individual investments, the first step in building a portfolio is setting clear investment goals. What are you saving for? Retirement, buying a house in 10 years, passive income. Clearly defined goals will shape how you actually construct your portfolio.
And then, similar to what we discussed before, the time frame you have for these goals, short, medium, or long term, that really dictates how you should structure the portfolio, doesn't it?
Absolutely. Your portfolio should ideally include a mix of assets with varying maturity periods that align with your different financial goals and their timelines.
Right.
This allows you to potentially benefit from different market conditions and adjust your portfolio as your goals change over time. What's also key here is understanding your personal risk tolerance.
Ah, yes, risk tolerance.
Yeah. They highlight different approaches: conservative, moderate, and aggressive.
Can you maybe explain what those different risk levels generally mean for how someone might invest?
Certainly. A conservative investor, well, they might be new to investing, or maybe they're primarily focused on protecting their current savings.
All right.
They'll typically favor investments known for stability, even if the potential returns are lower. Bonds, FDs, that sort of thing.
Got it.
A moderate investor is comfortable with some level of market fluctuation in pursuit of potentially higher returns over, say, a medium-term horizon.
A bit more risk for potentially more reward.
Exactly. And then an aggressive investor, they're generally willing to take on more significant market risk with the aim of achieving the highest possible returns, usually over a longer period.
Okay.
Understanding where you fall in this spectrum is vital for choosing investments you'll actually be comfortable sticking with, even when the market gets choppy.
That makes sense. It's about finding that balance between growth potential and your own comfort level with, well, the possibility of losses, while keeping your goals and timeline in mind. Now, something that can easily be overlooked are the actual costs involved in investing.
Exactly. That's a great point. Investment costs, while not always obvious, can have a significant impact on your returns over the long run.
Like what kinds of costs?
Well, things like commissions you pay to brokers when you buy or sell, annual fees for managing your account, expense ratios for mutual funds and ETFs that covers their operating costs, even surrender charges if you pull money out early from certain things like annuities. It's crucial to factor these costs into your decisions.
So keeping an eye on these costs is really important for maximizing returns over time. Are there specific ways we can try to keep these expenses down?
Yes, definitely.
Okay.
If you're looking at mutual funds, seeking out what are called no-load funds can help. These don't charge a sales commission when you buy or sell shares.
Okay, no load. Got it.
If you're trading stocks directly, it's smart to compare the commission structures of different brokerage firms. Find the most cost-effective option for how you trade.
Right.
Even small fees can really add up over many years. So being mindful of these expenses is a fundamental part of successful wealth creation. Think of a mutual fund's expense ratio, like the operating cost of a business. Lower is generally better because more of the potential profit stays with you.
That's a good analogy. And of course, with any investment, there are risks. What are some of the key risks we should be aware of?
Yeah, risk is always part of the equation. A couple of crucial ones to understand. First, the risk of losing your principal. That means you could potentially lose some or even all of your original investment. The level of this risk varies a lot depending on the investment type. Some are just inherently more volatile than others.
Okay.
The second major risk is inflation. Over time, the purchasing power of your money can decrease because prices go up.
Right. Your money buys less.
Exactly. This is particularly important for investments that offer a fixed rate of return, because that return might not keep pace with inflation. So your real return, what your investment actually buys you, could be quite low or even negative.
So we're aiming for growth that beats inflation while also being aware that investments can lose value. It's definitely a balancing act. And you mentioned actively managing the portfolio earlier, maintaining balance.
Yes, simply buying a mix of investments isn't quite enough. You need to pay attention regularly. The proportions of different asset classes in your portfolio, that process is known as rebalancing. It's crucial for long-term success.
Why is that?
Well, over time, some of your investments will naturally do better than others, right?
Sure.
That causes your original mix of assets to drift away from your intended allocation. Imagine your portfolio is like a balanced diet. Over time, you might accidentally eat way more carbs than protein. Rebalancing is like consciously adjusting your plate to get back to that healthy mix.
Okay, so how does rebalancing actually work in practice? What do you do?
Well, periodically, maybe once a year, or when things get significantly out of whack, you'd sell some of the investments that perform really well
Okay.
and reinvest those proceeds into the asset classes that are now underrepresented in your portfolio. It helps make sure your portfolio stays aligned with your desired level of risk and potential for growth.
Can you give an example?
Sure. Let's say you start with a balanced portfolio, maybe 50% in stocks for growth, 40% in bonds for stability, and 10% in something else like cash or commodities.
Okay, 50, 40, 10.
Right. If after a year or two, your stocks have done really well and now make up, say, 70% of your portfolio,
Okay.
while your bonds and other holdings have shrunk proportionally, you'd sell some of those stocks. Then you'd use that money to buy more bonds and other assets to bring the percentages back closer to your original 50-40-10 target.
That makes sense. It's a systematic way to sort of lock in some gains and manage risk, preventing your portfolio from getting too concentrated in one area that might have just had a good run.
Precise.
Now, this next point is something we might not always think about in such practical terms when it comes to investing, managing our emotions.
Oh, this is a huge one. Critical, yet often underestimated. Our emotions, things like fear and greed, can often lead us to make impulsive, irrational decisions.
Yeah, I can see that.
And those decisions can really hurt our investment outcomes in the long run. For instance, during a market downturn, fear might tempt you to sell everything at a low point.
Panicking.
Exactly, panicking. And then you miss out on the potential recovery. Conversely, when things are booming, greed might push you to chase after really speculative investments without properly assessing the risks involved.
Right. Fear of missing out, FOMO.
Exactly that. It's vital to develop the discipline to step back and not let these emotions drive your investment strategy. I know someone who panicked and sold during a dip, only to watch things bounce back pretty quickly. It's a tough lesson.
Definitely sounds easier said than done, but a crucial reminder. Okay, let's shift gears a bit and explore the different types of investments available. We've got some good overview info here.
We do. Several main categories stand out. First, there are fixed income securities. Think bonds, fixed deposits.
Okay.
Generally lower risk, providing a relatively predictable stream of income through interest payments.
Got it.
Then you have equities or stocks. This means you own a small piece of a company. They offer potential for higher returns, but definitely come with a higher level of risk. Common stock usually gives you voting rights. Preferred stock often pays a fixed dividend, but maybe no vote.
And then we have mutual funds, which we've already touched on a few times.
Exactly. Mutual funds pool money from lots of investors and invest it in a diversified portfolio. Stocks, bonds, etc., all managed by professional fund managers.
Right.
We see mention of equity funds, mostly stocks, debt funds, mostly bonds, and hybrid funds, a mix of both.
Okay. What else?
Real estate is another big one. Physical property, potentially for rental income, value appreciation, maybe some tax benefits. And finally, there are alternative investments. Things like gold, hedge funds, private equity. These are less traditional assets that can offer further diversification.
Okay, a really broad range of options there. Let's zoom in a bit more on mutual funds, as they seem like a popular way for many people to get diversified.
Good idea. They're very common. So a mutual fund fundamentally is a professionally managed investment vehicle. It pools money from many investors
Right.
to invest in a diverse range of securities, stocks, bonds, short-term stuff. The fund manager or portfolio manager makes the decisions. They try to hit the fund's goals while managing risk for everyone invested.
And mutual funds have been around for a while, haven't they?
Yes, quite a history. One of the earliest examples was the Massachusetts Investors Trust back in 1924.
Wow.
The industry definitely faced challenges, especially during the 1929 crash. That actually led to important regulations like the Securities Act of 33 and the Investment Company Act of 40. These were designed to ensure funds were registered, transparent, and offered investor protection.
So regulations came out of crisis.
Often the case. Then later in the 20th century, especially with the rise of retirement savings plans, mutual funds really took off. That included the emergence of index funds. John Bogle at Vanguard pioneered the first one for everyday investors in '76. That fund's still huge today.
Interesting history. So what are the different types of mutual funds we might encounter?
Well, they can be categorized in several ways. You have open-end funds, the most common type. They can just issue new shares when people want to invest.
Okay.
Then there are exchange-traded funds, ETFs. These trade on stock exchanges like individual stocks, but their price usually tracks the value of their underlying assets pretty closely. They kind of combine features of mutual funds and stocks.
Right. I've heard a lot about ETFs.
Yeah, they become very popular. Equity funds, as we said, focus on stocks. They can be further broken down by style, like growth stocks versus value stocks, or by the size of the companies. They invest in small cap, mid cap, large cap.
And we also have that distinction between index funds and actively managed funds.
Yeah.
Exactly. Index funds just try to copy the performance of a market index, like the Nifty 50 or Sensex. They usually have lower fees because it's a passive approach. Actively managed funds have managers trying to beat the market by picking specific investments. Then you also have bond funds, money market funds, very short-term, low-risk debt, and even funds of funds, or FFs, which actually invest in other mutual funds.
A fund that invests in funds.
Okay.
And when we're looking at a mutual fund, how do we know its current value?
That's where the net asset value, or NAV, comes in.
Yeah.
The NAV is basically the current market value of everything the fund owns, minus any liabilities, divided by the number of shares. It gives you a per share price.
Okay.
For most mutual funds, this NAV is calculated once a day after the markets close. Also really crucial are the fund's expense ratios.
Right. The costs again?
Exactly. These cover the annual costs of running the fund management fees, operating expenses, maybe marketing fees called 12B1 fees.
Yeah.
These expenses directly eat into your returns, so you need to know what they are.
Lower is better, generally? Generally, yes. It's also worth noting the difference between load funds, which charge a Thiel's commission when you buy or maybe sell, and no-load funds, which don't have those sales charges. Again, think of the expense ratio like ongoing maintenance. The less you pay, the more potential return stays with you.
Okay, that gives us a much clearer picture of mutual funds. Now let's step into the world of cryptocurrency. It's a topic that generates a lot of buzz, but can also feel pretty complex.
It certainly can. Cryptocurrency is essentially a digital form of currency. It exists only online, based on computer algorithms, and operates without a central authority like a bank or government.
So no physical coins.
Purely digital. Bitcoin, launched back in 2009, was the first one. Since then, literally thousands of others have popped up. In India, some popular ones you hear about are Bitcoin, Ethereum, Tether, Cardano, Binance Coin, Polkadot.
Quite a few.
Yeah. And the volatility in crypto, it's not just market fluctuation like with stocks. It reflects how new it is, how much sentiment drives it. It really means you need to understand your own risk tolerance on a deep level before even considering it.
That's a good point. And for someone looking to invest, where would they even begin?
Well, the source emphasizes picking the right platform for trading. Several popular exchanges in India get mentioned: WazirX, CoinSwitch Kuber, CoinDCX, ZebPay.
Okay.
These platforms let you buy, sell, and trade different cryptos. And it's a market that basically never sleeps 24/7.
Wow. Now, can you give us a quick rundown on some of the major cryptocurrencies mentioned? What makes them tick?
Sure. Bitcoin, the original, uses blockchain technology that's basically a secure, transparent digital ledger for recording transactions without needing a middleman.
Okay.
Ethereum is another huge one. It's also a blockchain network, but it's more versatile. It allows users to build other things on top of it, like other digital tokens or decentralized applications. Binance Coin is linked to the Binance exchange used for trading fees, payments within their system. Cardano is newer, getting attention for using a more energy-efficient way to verify transactions, called proof of stake.
Oh, okay.
And Tether is what's known as a stablecoin. Its value is pegged to a traditional currency, usually the US dollar. The idea is to offer more price stability compared to other cryptos that can swing wildly in value. Think of it like a digital dollar token.
Trying to bridge the gap a bit, but with all the hype about high returns, it's crucial to talk about the risks too, right?
Absolutely crucial. Several key risks stand out. One is the limited legal recourse. Because it's largely unregulated, if something goes wrong, say an exchange gets hacked, you might not have the same protections as with traditional finance.
That's scary.
It can be. The market is also famously volatile. Prices can swing dramatically, very quickly. Another issue is crypto whales. These are people or groups holding huge amounts of a crypto. They can potentially manipulate prices, sometimes hurting smaller investors. But Despite all these risks, the potential for really substantial returns is also there. That's a big part of the attraction for many people.
Okay, so definitely a high risk, potentially high reward area. Now, as we navigate all these different investment options, we also need to be really mindful of things going wrong, specifically investment fraud.
Yes, absolutely. It's a really important thing to cover. While the stock market and other investments can be great for building wealth, investors must be vigilant against fraud and scams.
What kind of scams?
Common ones include pump and dump schemes, fake advisors promising the moon, and phishing attempts trying to steal your financial information.
Pump and dump. That sounds nasty. How does that work?
Typically, fraudsters buy up a lot of shares in a cheap, maybe obscure company. Then they spread false or misleading positive news about it online, social media, wherever.
Creating hype.
Exactly, creating hype to artificially inflate the stock price. That's the pump. Once unsuspecting investors jump in and the price is high, the fraudsters sell all their shares for a profit. The price then crashes, leaving everyone else holding the bag. That's the dump.
Nasty indeed. And what about these fake advisors? How do they operate?
They often try to look super knowledgeable, maybe showing fake track records, promising secret strategies or guaranteed high returns. Big red flag right there. No one can guarantee returns in the market. Legitimate investments always have risk.
Right.
It's critical to only get advice from advisors registered with SEBI, the Securities and Exchange Board of India. You should always verify their registration on the SEBI website. These fakes might pressure you to act fast, try to get access to your accounts, or charge huge upfront fees for nothing legitimate.
And phishing is about stealing info.
Exactly. Emails, tests, calls, designed to look like they're from your bank or broker. They try to trick you into giving up passwords, OTPs, personal details so they can access your accounts and steal your money.
So what are some practical red flags that you, the learner, should really watch out for to stay safe?
Okay, some key things. Be extremely wary of promises of sure profits or risk-free investments. If it sounds too good to be true, it probably is. Watch out for high-pressure tactics, anyone rushing you to decide without time for research. Be suspicious of overly complex jargon used to confuse you.
Right.
Always verify if an advisor is SEBI registered. And finally, be very skeptical of investment tips you get randomly on social media or messaging apps. Legitimate advice doesn't usually come that way.
Okay, good tips. And if someone does, unfortunately, fall victim to a scam, what should they do immediately?
Act fast. Report it immediately to SEBI through their Scores website. Inform your bank about any unauthorized transactions or if your account might be compromised. And file a cybercrime report. You could do this online at the national portal or go to your local police station. The quicker you act, the better the chance, however small, of potentially recovering funds. And remember, building wealth genuinely takes patience, understanding, and long-term thinking. It's not a lottery.
That's a really crucial reminder for everyone. Finally, there was just a very brief mention of stocks versus real estate. Seems like that could easily be a whole deep dive on its own.
Absolutely. They're just highlighted as two distinct asset classes, each with its own characteristics, pros and cons. Definitely something we could explore in much more detail another time, looking at how they compare as ways to build wealth.
Okay, so we've covered a significant amount of ground in this deep dive. Let's try and bring all the key takeaways together.
Right. So to summarize, wealth creation really is an ongoing journey. It starts with figuring out your personal financial goals and understanding your own tolerance for risk. It involves strategically picking the right investment tools for those goals while always keeping an eye on costs and potential risks. Actively managing your portfolio through rebalancing and, importantly, managing your own emotions. Those are critical too.
Yeah.
Plus, it's essential to keep learning about the different investment options out there. Traditional stuff like fixed income and stocks, mutual funds, even newer things like crypto, all while staying super vigilant against fraud.
And a key point that came up early on is the huge advantage of starting to invest early, giving your investments time to grow, really letting that power of compounding work for you.
Precisely. Often how long your money is invested is more important for building long-term wealth than trying to perfectly time the market highs and lows.
So the learner, considering this wide array of investment options we've discussed and the ever-present need to be aware of potential fraud, what single concrete step will you take this week to further your own understanding of building long-term wealth? It's really all about taking that initial action and continuing to learn and think critically about your financial future.